Welcome to TMS Insights. This is the start of October. The end of September was a bit tough time in the markets. Jeremy Hook and Ben Clark bring to you the news. Ben, September, not great, down almost 6%.
Yeah. And I think sort of clients have been trying to understand what's going on because ironically, the US share market is within a whisker of its all-time high. European markets are still very strong. It's really been our market globally that's been the only one that's fallen quite heavily.
And to make sense of all of that, I mean, it's important to show how integrated currency and commodity markets and bond markets are with our share market here.
Right.
And we're right at the end of the link of the chain there. And really, it's a currency play mainly, isn't it?
It is. I mean, our currency has fallen, I think it had fallen 7 cents in about 13 trading days. And that was due to two main factors. The iron ore price finally capitulated, and we also saw US bond yields start to spike higher, which meant that the relative interest rate between the US and Australia sort of shrunk in the US's favour, and money started to move out of Australia back to the US. As the currency fell, of course, international managers who own Australian shares started to wear loss in a US dollar perspective and started to sell down their shares and pull money back into countries like America. But arguably, that's probably started to create an opportunity.
Well, this is it. That's what's happened. And what does it mean now, though? I mean, at 52.92, where the ASX 200 closed at the end of the quarter, we see really good buying opportunities in quality stocks. We thought the market was a little pricey prior to that. It's not at discount levels, Ben, at the moment, but there's good opportunities to buy stocks at fair value or below it.
Yep.
And certainly for a yield-hungry environment, great yield from some big stocks that we know and like, such as the big banks.
Yeah, because ironically what happened during this time is that the more defensive, conservative, higher dividend paying companies have actually been the shares that have been hit the hardest. Whereas the growth stocks, things like CSL and those sort of companies have barely fallen at all.
Yeah.
And that's where, from a local point of view, interest rates in Australia aren't going higher anytime soon. If anything, I think the RBA would like to even drop once more if it had no ramifications in the housing market. And hence we think that local investors are probably at the point where they'll start to step in. The banks, I think we would agree, we wouldn't say they were cheap at the moment, but they're probably around fair value, but in an operating environment that's very good for them.
Yeah.
So you would expect that they trade fair to maybe a bit more expensive in this environment at the moment.
I'll certainly agree with you on the bank story, and I think we certainly have been using the opportunity to find some good value buying those. I'll take the bet on the RBA cutting rates next time because I don't agree with that, but there we go. But more or less, this market opportunity has been a buying one for us. So we've been seeing that those big cap stocks look really good. Woolworths looks good at the moment.
Yep, so Woolworths is one that we've certainly been purchasing. It's fallen about 10% from its post-result August sort of level of $37. Got back to about $34 yesterday. That's on a yield just over 6%, including franking credits. And we think the business not only is sort of flexing its muscles again in the food and liquor business, which are the stellar sort of parts, but the Masters chain, which gets a lot of press, is such a small part of Woolworths business that arguably the negative sentiment towards Masters we think's created an opportunity where we can start to buy some Woolworths shares now. I mean, Wesfarmers has been the stock we favoured given the Wes Ends that we held across the board for clients, but and Coles did very well over those 5 years, but Woolworths seems to be having another push now, particularly with the use of technology, and that looks like a good buy.
And there are also some opportunities in some of the interest rate securities. They've come back. They don't tend to do that because they more or less hold their value. But again, even if you're looking at the more conservative end of the market for something which is yield really only, again, better yield than we could see a month ago when it was pretty pricey.
Yeah, and I think we should mention just with the banks and the hybrids, there is the David Murray banking review comes out in November. That's one of the reasons banks have also been on the back foot. He's been saying in the press that he believes the bank should hold higher levels of capital. We don't know how much extra capital, whether Tony Abbott will take up all of the recommendations, how long it will take to phase in those recommendations. So that sort of uncertainty, again, I think has created an opportunity in both the banking hybrid space and also the bank share space.
And that's typically the way. There's a bit of uncertainty now. That creates a price opportunity. In all likelihood, any changes will be relatively small, but that's something we have to wait and see. So please get in touch with us about the market now. It's a good time to talk about some of the opportunities that have been presented by that weakness. So rather than being panicked or anything like that, we're certainly not. We can see it's a good time. A couple of other things before we leave today's segment. Firstly, the Telstra buyback.
Yep.
A big talking point, but maybe not a lot to do there, Ben.
No, well, I think we were thinking when Telstra was trading at $5.70 and you're effectively going to be selling some shares at about $6 back to the company, we were quite happy to do that because we see Telstra quite fully valued at $6. But with the fall in Telstra share price, with this correction in the market, we're now sort of recommending to clients that, you know, A, it's going to take a lot of time to get the money back. It will be heavily scaled back. It's only going to be a very small portion of their parcels. And, you know, the price that you'll end up selling at is probably not more a whole.
Marginal sort of thing, isn't it?
Yeah.
And you've got, if you do sell into the buyback, you've got to find a way to replace a big blue chip stock which is performing well and paying an excellent dividend.
Right.
You know, so
and one that could be Medibank.
Medibank. So obviously a lot of talk this week because the federal government has announced at last that they will privatise Medibank, and that is an excellent business that we're quite interested in seeing how we go about it. It's early days now. At this stage, all we can do is pre-register for a prospectus. TMS Capital will be endeavouring to meet with management and also to apply to get stock in the broker firm offer. We'll obviously have to update our clients on that later, but conceptually a very appealing company.
Definitely, and from all reports it's going to be floated with zero debt on the balance sheet. And we saw with another company, NIB, that was demutualised and floated on the stock exchange, it also came onto the market with no debt and it's paid a huge amount of special dividends. It's moved to a gearing ratio of 30% and has used a lot of capital management initiatives which have been very advantageous for shareholders to do that. But I think we sort of both agree conceptually 90% of businesses that have been floated out of government have tended to do well in private hands as efficiencies are sort of eked out and earnings growth has sort of ensued. So it looks like a good sort of business. It's just where's it going to be priced? More details once we get a prospectus through and hopefully meet with management.
Yeah, exactly. Terrific. That's all we've got time for today. Please get in touch with us. Obviously, a few things current and worth talking about. We're here to help you and to discuss these things with you. And also, too, more generally, these TMS Insights, which we've been running for over a year now, we're very interested in any feedback you've got, positive or negative. But that's all for today. We look forward to bringing you the next edition in November.